Okay, we are here, lecture 31. The end is in sight. The end is in sight. I only assigned one homework problem, is that correct? As a refresher, this is the chapter 9 on receivables, and we are talking about how do we account for the inevitability when people don't pay their accounts, okay? We talked about how we're going to estimate bad debt expense because we want that expense to be matched in the same period as the related sales. We want to follow the matching principle, right? Now, we talked about how under the allowance method, to estimate bad debt expense, this is always the entry, is it not? Always, always, always. Now, we have some different ways of coming up with the number that goes into that journal entry, but that is always the account that's debited. That's always the account that's credited. Is that correct? Okay. So let's go ahead and go over to the one problem that I assigned, which was problem 9.2a. Okay. Now problem 9.2a, and I think I had you skip requirement number 2. Is that correct? So skip that one. All right, at December 31, 17, Hawk Company reports the following results. They give us cash sales amount. They give us the credit sales amount. Obviously, the summation of those is the total sales, correct? In addition, its unadjusted trial balance yields the following items. Accounts receivable, that is the balance of it. And then the allowance for doubtful account has a 16,580 debit balance, correct? Okay. Prepare the entry for this company to recognize bad debt expenditures under each of the following independent assumptions. Okay, and they give us 3 different assumptions, right? The first 2, A and B, are percentage of sales methods, right? Percentage of sales, simple. You don't have to do the T account analysis. C, we have to do, or part C, rather though, we're going to do 5% of year-end accounts receivable. And that's where you do have to look at the T account, correct? So let's make those entries. We know that each one of those entries is going to be independent of each other. And we know that each one of those entries, that's the account debited and that's the account credited, correct? So let's take a look at the answer to that. Okay, in the first situation, I believe it's 1.5% of credit sales. Is that correct? Yeah? Okay. So we don't have to do a T account analysis. There's the entry. We take 0.015, which is 1.5%, times credit sales of 5,682,000, and boom, that's the number that goes in there, isn't it? Okay. Any questions on that? Okay. Make sure you're doing your homework in this chapter. Do them in all the chapters, but especially do your homework problems in this one. Because you want to learn this stuff. Okay, part B, we're doing 1% of total sales, right? Now, I told you total sales is this number right here, right? 7,587,000. So 1% of that is 7,580. Now, whether it's a percent of credit sales or a percent of total sales, you don't have to do a T account analysis, okay? Students always struggle with when they do that T account analysis and when they don't. Percentage of sales, you don't have to do it. Okay, questions? All righty. Part C of number 1. An aging analysis estimates that 5% of year-end AR is uncollectible. Okay, in this situation, we're going to take 5% of accounts receivable, and that's 63,505, correct? We're showing that on the, okay? 5% of accounts receivable, and that is 63,505. Now, that is not the number that goes in that entry, is it? That's the number that we want to be the ending balance of allowance for doubtful accounts. but it has a beginning debit balance, right? Okay, so what do we have to do? We have to credit it for 80,085. Is that correct? Okay, let's do a little side note here. Okay, little side note here. This, thank you. This is our allowance for doubtful accounts account, right? Let's make it easy math. Okay, let's say we want it to have a $1,000 balance and it has a $100 balance. What do we have to do?
Add 900.
We have to credit it for 900, right? Okay. Well, let's say that we had an allowance for doubtful accounts and we still want it to have an ending balance of 1,000, but now it has a $100 debit balance. What do we have to do? We have to credit it for how much? 1,100, right? Okay. And that's the situation that we are in here. Okay. Is we want the ending balance to be 63,505. The beginning balance is 16,580 to the debit. So, you know, some people go, do you add it or do you subtract it? I always just think of it as, okay, it has a debit balance. We want it to have this credit balance. What do we have to do to it? And I don't say so much we add or we subtract. I say we have to credit allowance for doubtful accounts to bring it from a 16,580 debit to the desired 63,505 credit. And that's the number that goes in the entry. Does that make sense? Okay. I think it's easier to do the T account than what they do right here. Okay. All right. Now I wanted you to do part C on this as well, didn't I? Okay. So let's skip part 2. And let's go down to part C. I'll cover up part 2 so it doesn't get confusing. Okay. Okay, part C, or part 3 says, how would accounts receivable and the allowance for doubtful account appear on the December 31, 17 balance sheet given the facts in part 1C? Well, you would say in the current asset section, accounts receivable equals 1,270,100 less the allowance for doubtful accounts ending balance, which is what? 63,505. Now you're not subtracting the entry that we did to it. You're subtracting the ending balance of it, right? Okay. So the 1,270,100 minus that ending balance of 63,505 equals 1,206,595. And I call that the net accounts receivable, or sometimes the net book value of accounts receivable. Now here's another way you can show it. I kind of prefer that top way. But I love to ask this on a test, folks. I love to ask, how does this look on the balance sheet? Because I always think if you don't know how something looks on the financial statement it goes on, you probably don't really know what's going on. You with me? Okay. Cool? Any questions on that one? Any questions on that one? Okay. I've taught this class enough times that I know that this test question is one that students have a tendency to struggle with. Okay. I want to work on another one in class, and it's real doggone similar with just different numbers. But I want to do problem 9-2B. And once again, I want you to skip requirement number 2. Okay? Okay? I want you to do problem 9-2B. Now, I'm not going to give you an infinite amount of time to do this, okay? Because there's some other things I want to make sure that I get through. Okay? So, folks at home, you can just pause us, and then when you're done with problem 9-2B, remember to skip requirement number 2, you can start us up. But they'll play that music for you folks. Let's do problem 9-2B, except for requirement number 2. Nobody pays. Hey, how you doing? Let's take a look at the answer. I don't want to dwell on this because there's other things I want to get to. So I'm not going to read the whole problem to you, but let's show the answers here, okay? Let's look at the first two, part 1A, 1B, 1C, okay? It's really the same stuff except just different answers. You can just leave that up there. They don't need to see me. But in the first instance, we take 2.5% of credit sales, which was 1,342,000, right? Percentage of credit sales, simple. Don't have to do the T account analysis. Okay? Second instance, it's at 1.5% of total sales. Now again, as you saw in the problem, total sales is the summation of credit sales plus cash sales, right? So when we take 1.5% of that, we get 35505. That goes right into the entry. Part 1C, it's 6% of accounts receivable. Okay? So we want the ending balance to be 34,500, which is 6% of accounts receivable, but it has a beginning balance in the credit of 7,500. So we have to credit the account for 27,000, right? Okay? And then part C, you can see down here in yellow at the bottom. Okay? You'd show the accounts receivable less the ending balance of allowance for doubtful accounts. That equals net AR of 540,500. Okay? You can do it either way. I kind of like the way in the yellow, the better. Okay? Questions on that? Okay. I want you to be starting to get that, okay? Okay. So, okay. Any questions on that? All right. Let's go ahead and move on. Now, we talked about, well, let me go back to that slide real quick. Let me go back to that slide where we talked about, here we go. This is the slide where we talked about how do you come up with the number that goes into this entry right here, right? We know that's the entry. These are the amounts these are the methods for coming up with the number that goes into that journal entry. And I believe we talked through these methods right here, but we didn't get to the aging method, right? So now we're going to talk about the aging of accounts receivable method. So you can come off that. So here is kind of the crux of the aging method, okay? Let's say, Kyle, that your company owed me $10,000, okay? And let's say, Tony, your company also owed me $10,000, okay? Now, it's been 25 days since I delivered the product to your company for which you owe me $10,000, okay? So your account is about 25 days old. For you, it's been 200 days since I delivered your product. So your account is about 200 days old. Now, of these two guys, of these two companies, who do you think is less likely to pay me? This guy, 200 days old, isn't it? Okay? That's why people don't want their receivables to get old. Because the more time that goes by, you're starting to think, hey, I've gotten along pretty well without paying this account. This feels okay, right? So, the aging method says, okay, we're not just going to take a percentage times total accounts receivable to see what our estimated, or to see what our ending balance should be of allowance for doubtful accounts. We're not concerned just with the total amount. We want to know, how is that receivable comprised? Is it a bunch of old accounts? Is it a bunch of new accounts? Do you see what I'm saying? So what they do, and it's going to be best illustrated with an example, is they look at an aging of accounts receivable. Now, this right here is an aging of accounts receivable, okay? That is an aging of accounts receivable. It doesn't just give you the total amount. It does give you the total amount of 100,000, but it says, okay, 64,500 of that is not even due yet. 18,500 is 1 to 30 days past due. 10,000 is 31 to 60 days past due. 3,900 is 61 to 90 past due. And 3,100 of it is really old. It's over 90 days past due. Now, in the percentage of total AR method, we would just take a percentage times this number, and that would be the desired balance, ending balance of allowance for doubtful accounts, correct? But in the aging method, we're going to take each one of these aging amounts times a percentage, okay, to get that amount in blue over there, okay? Now, obviously, the older the account, the higher the estimate of uncollectability. So this really old stuff of $3,100 that's over 90 days past due, we're going to multiply times a pretty high percent of uncollectability estimate. You with me? And this is what we want to be the ending balance of allowance for doubtful accounts, this 5320. But do you see how we came up with that? Not just by taking one percentage times the total, but we took individual percentages times the aging, okay? Now, if you go back in these slides, you'll see that the beginning balance of allowance for doubtful accounts, this was given to us in earlier slides, was a $900 credit. Here's that 5320 from the previous slide, okay, that we want to be the ending balance. So what do we have to do to it? We have to credit allowance for doubtful accounts for 4420. Does this make sense? Okay, so we have to analyze the T account. It's still a percentage of receivable method. It's an aging of receivable, but it still has to do with that methodology. Are you with me? Okay. Questions on that, folks? I believe I have a homework problem for you to work on that, okay? All right. All right, let me show you this. You're getting tired of seeing this, I know. But once again, under the allowance method, when we estimate bad debt expense, this is the journal entry, right? We debit bad debt expense and we credit allowance for doubtful accounts. Now we're going to talk about something different. We are going to talk about writing off a specific bad debt. Now we are not estimating bad debt expense here. That's something different. Okay? When we did that, this was the entry. Now we're talking about writing off a specific account. We know about a specific customer who's not going to pay us. Maybe we read in the paper that they went bankrupt or something. Okay? Now, when we use the allowance method, when we write off a specific account, this is the journal entry. Let me just put it on the document camera. When we, under the allowance method, when we write off a specific account, let me put them both on here so you can contrast them. When we write off a specific account under the allowance method, this is the entry. We debit allowance for doubtful accounts and we credit AR. Now we can credit AR here, which we know necessitates going to the detail, the customer subsidiary detail, and adjusting a specific customer amount. But we can do that because we are writing off a specific account. Are you with me? Okay, so let's take a look at an example. Okay. Barton, that's us, we're Barton. We determined that one of our customers named Martin, their $300 account is uncollectible, okay? Maybe we read that Martin died, okay? And so we're like, okay, well, doggone it, we're going to have to write this thing off. You with me? Okay? Colton.
Okay, so what if you write off account or write off an account, and then that person just like they decide to cleanse their soul or whatever, clean their record, and pay you later.
It's a great question. We're going to go through that
Okay, cool.
in about 60 seconds. Good question. But at this point in the slide, let's say that we read that Martin is died, okay? And we're not going to be able to collect his account, okay? Well, here is the journal entry we make. We debit allowance for doubtful accounts, and we credit accounts receivable for Martin, okay? We credit accounts receivable for Martin. Now, we know we're going to have to credit the control account of AR as well as the subsidiary detail, correct? Okay. Now, do we debit bad debt expense when we write off a specific account? Do we? Do you see bad debt expense being debited? No. We debit bad debt expense when we estimate bad debt expense. Here we're writing off a specific account. This should be something that you write in your notes because that's very, very important. People always get this confused. I'll ask them on the test or in a quiz to write off a specific account. And by golly, every fiber of their being wants to debit bad debt expense. But we don't debit bad debt expense when we write off a specific account. We debit bad debt expense when we estimate bad debt expense. We do that so that it will be matched to the same period as the revenue it's related to. Are you with me? Okay. So back to our example. This is what we do to write off a specific account. Now let's go to Colton's question. Guess what happens a little later? On February 8th, guess what happens? Martin's widow walks in and says, I understand that my husband, who you've heard, has departed into the great beyond. I heard that he owed you, how much was it, $300? And I just can't sleep at night because our family is the type that we don't leave debts unpaid. So we want to pay you, Barton Company, we want to pay the $300. Now, do we tell her we've already written off your account, plus we would never collect money from a widow? No, we collect the amount, don't we? Right? Okay. So what we do, the first thing that we do is we make this entry right here on February 8th. Now look at that entry at top. Look at this entry and note that it is just a reversal of the entry when we wrote off the account. Okay? There, when we wrote off the account, we debited allowance and credited AR. What we're going to do here is we are going to reverse that. We're going to debit AR and credit allowance. That, in essence, negates that we made that entry earlier. And then, on that same day, we show the cash payment of the receivable, just like we would any other cash payment of a receivable. We debit cash and we credit and reduce AR, okay? Now, some people might say, now, wait a minute, Dave, this looks kind of goofy because these are both the same date, right? February 8th, February 8th. You can show me with the screen if you could, okay? These are both on February 8th. We debit AR and then we immediately credit AR. That seems kind of dumb. Why don't we just do one entry and we debit cash and credit allowance? Well, the reason we do it this way is we want that activity to be recorded in their receivable other customer detail, the subsidiary customer detail. We want it to capture what happened here. So we reverse the entry we made when we wrote it off, and then we show the cash collection. Make sense? Okay. All right, I want to take I'm only going to give you a couple minutes because it's a pretty easy one. But what I want to do is I want to do quick study 9.5. I want to do quick study 9.5. They're going to play that music, but I'm only going to give you a couple minutes to do it. Okay? I'm going to make sure we get through the lecture. So quick study 9.5 is what we're doing. While they play that music, we will go over the answer in just a couple minutes. right, let's go over that one. And I'm going to add a little element to it that you did not need to have to do the problem. But I want to add this element to teach you something else about writing off an account. Let's say that before we wrote off this account, let's say that this was our situation. Now again, you didn't have this, I'm just kind of making this up, okay? But let's say that before we wrote off this account, the accounts receivable for the company was in total $100,800, and the allowance for doubtful accounts was a credit balance of $3,800. So we subtracted that to get net AR of $97,000. Are you with me? That's before the write-off. Okay? That's before the write-off. We know how that looks on a balance sheet, right? Okay, then what we do is we write off this account, correct? I won't read the problem to you since you just did, but we're writing off the $800 account. So the entry to write off the account under the allowance method is this right here, correct? Is that right? We debit allowance for doubtful accounts. We credit AR for green for $800. We wrote it off. Are we debiting bad debt expense here? No, we are not. Okay, that was done when we estimated bad debt expense. So here we are writing off the account. You with me? Questions on that? I know we're not done with it, but any questions on it so far? Okay, what I want to do is, let's see if I can show this all together. I believe I can. Okay, this was before the write-off that we did down here, right? Now what I want to do is I want to rewrite these amounts for AR allowance and for net AR after the write-off, okay? After we do this journal entry right here, okay? Well, let's do the bottom part first. We credited accounts receivable. Accounts receivable is a debit balance account, right? So when we credit AR, we are decreasing it. Is that correct? So AR would now be $100,000. Is that correct? You with me? Okay, allowance for doubtful accounts. As a reminder, what type of account is that? What is it?
Contra asset.
Contra asset. And it has a normal credit balance, right? So when we debit it, we're actually reducing it, right? So it no longer has a balance of $3,800. It has a balance of $3,000 because we reduced it. Is that correct? Is that right? So what is our net AR after the write-off? It's still $97,000. It didn't change, did it? Same amount. When we write off a specific account, the net AR doesn't change. Yes, we reduce the accounts receivable, but we also reduce that thing that's being subtracted from accounts receivable in arriving at net AR. Does this make sense? So that's something I want to point out. Okay, questions on that? Okay. Now, this was the entry when we wrote off the account. But then guess what happens on March the 9th? This person or this customer of ours wants to come in, and they probably gave us something like this. They said, hey, I know I owed you $800. I can't pay you the whole amount, but I would like to at least give you $300. Now, we reverse $300 of that previous entry. Now, if he said, hey, I can give you $300 now, but I really want to pay off the whole thing eventually, then we would reverse that entire entry. But let's just say that he said, I'm not going to be able to give you anything more than $300, but I want to at least give you $300. Well, then we reverse $300 of the entry that we made on January 31st when we wrote off his account. And then we record the cash receipt of $300, okay? Yeah, Kyle.
If we have like another problem like this on a test or something, would it be more clear as to whether he wanted to pay the whole thing?
Yeah.
or-
Yeah, I'd make it real clear if he wanted to repay the whole thing versus just that amount. So this one was a little vague, wasn't it? So, okay. No, I'll make it clear on a test or quiz. Okay. All right. Questions on that, folks? All right. Okay. We just have a few more things to talk about. Okay. And then we shall call it a day. I know there's a lot of stuff in this lecture. I'm giving you your money's worth, right? Folks at home, you can push pause and go have a drink of Perrier water if you'd like. You folks here, you have to just stay and gut through it, okay? All right, let's go to the next slide. Let's summarize what we talked about. The percentage of sales method obviously has an income statement focus, right? Because sales is an income statement account, correct? The percentage of receivable methods obviously have a balance sheet focus because accounts receivable is a balance sheet account. And the percentage of receivables and the aging receivables, that's when we have to look at the T accounts, correct? Okay, I think I've said that enough. Now I want to talk a little bit about notes receivable. Notes receivable. Okay, you can come off that for a second. One of the main questions I always get is what's the difference between an accounts receivable and a note receivable? Okay, an account receivable is like, let's say you're a customer of mine, Tanner, and you buy $10,000 worth of product, and I'm going to bill you, and I know you're going to pay me at the end of the month. Okay, we've done business together for a long time. Okay, it's not really formal. Kind of a handshake agreement. A notes receivable, though, is when you have a receivable on your books, but there is a signed note by the customer, okay? And there's usually interest involved. For example, does anybody here have a car loan? Okay, Nathan, the bank has a note receivable from you. It's more formal than just a handshake agreement, isn't it? Yeah. You signed the documents, yes, and you're paying some interest. So that's what a note receivable is, okay? Now, a note receivable can come about in two main ways. Number one, you could loan money to a customer, or if you're a bank, that's probably a very common occurrence, right? But if you're not a bank, you wouldn't probably be loaning a lot of money to customers, would you? Now, maybe you might have an employee or something that you loan a little money to help them out or something. But that's going to be a rare occurrence. A note receivable for a non-banking kind of company would probably be more of a situation where you make a sale and instead of booking an account receivable, you book a note receivable because it's a large enough amount. You with me? Okay. So let's take a look at note receivable. As I said, it is a written promise to pay a specific amount at a future date, and there's usually interest involved, okay? It might look something like this. 90 days after the date, I promise to pay the order of Barton Company. We're Barton Company. $1,000, valued with interest at 1% per annum. That means, 12% per annum, which means 12% per year, okay? Now, that's the terms of the note. The maker of the note is the one who is eventually going to have to pay that thing. Okay, the payee is us, Barton Company. We're the ones who put the receivable on our books. Okay, there's the principal, there's the interest rate. The interest rate is usually always stated on an annual basis. Certainly assume that it is unless stated otherwise. This is a 90-day note. Okay, so when Barton Company receives that money, are they just going to receive $1,000? No, they're going to receive $1,000 plus some interest, right? Now, how would we calculate that interest? Well, we calculate it by taking the principal of the note, in this case $1,000, times the annual interest rate, which in this case is 12%, and then we multiply it by the time expressed in years. This is a 90-day note. So we would take 90 divided by, we usually don't use 365, we usually use 360 because it's cleaner math, Okay? So that means that we would get, what is that, 30 bucks? So when Barton Company receives payment, they're not just going to get the $1,000, they're also going to get $30 of interest. Does that make sense? Okay, let's look at an example. Okay, on March 1 of 17, Matrix Inc. purchased a copier from us. We're Barton. They purchased a copier for $12,000 from us, and we gave them a 9% note, 9% note that's due in 90 days. Okay? So, when we book that sale, we credit sales. We don't debit accounts receivable, we debit note receivable, right? And sometimes we can abbreviate that N/R. Okay? Now, how much interest are they going to have to pay us at the maturity of this note? Well, we take the principal amount, which was $12,000, times the annual interest rate of 9%. This is a 90-day note, so we say 90 divided by 360. This is the total amount of interest that they're going to have to pay us on the maturity of that note. They're going to have to pay us $270 plus the $12,000 principal. So the journal entry is this. We don't just get cash, we're Barton Company. We don't just get cash of $12,000, but we get cash of $12,270. Now, $270 of that, excuse me, is the interest revenue that we earned. But then we also have to credit or decrease the note receivable that was on the books at $12,000. You with me? Okay. Questions on that? Okay. All right, let's go on. What happens if the maturity of the note comes to, that date comes, and our customer informs us that they cannot pay the note or the interest? Well, then we make that same journal entry, except we don't debit cash because they didn't give us cash. We debit accounts receivable, and we put that account receivable back on the books. Are you with me? And we do what we have to do to try to get that collected. Okay? All right. Questions on that? Okay, let's wrap up a few more things on this and we'll call it a day. One thing that we need to talk about is there can be the instance when a note receivable is outstanding at the end of an accounting period where we and at the end of the accounting period is when we prepare financial statements, right? Okay? You remember chapter 3? Seems like a long time ago, doesn't it? Remember chapter 3, AJEs, adjusting journal entries? Okay, I hope you remember that because the final is comprehensive in this class, isn't it? Okay? Well, what do we do when there is a year-end date and a note receivable is still outstanding? Let's take a look at an example. Okay, on December 1 of 17, Matrix Inc. purchased a copier from us for $12,000. It's a 9% note due in 90 days. Now, December 31 is our year end. We have to do financial statements. So what is the AJE that we book on that date? Well, we take the principal amount of $12,000 times the interest rate, and then we take it times not 90 days, but how many days have gone by between December 1st and December 31st. 30 days, right? So we take it times that time factor, and that gives us the amount of interest that is due on December 31st. Now, they're not going to pay us. We're not going to receive that in cash, but we have to book this AJE. We don't debit cash, we debit interest receivable. Remember that? Cobwebs starting to fall down? Chapter 3. We debit interest receivable for $90, and we book that revenue, we want to match it to the period in which it was earned. So this is the AJE that we make. You with me? All right, questions on that? Talk about two last quick things and then we're done. About another 90 seconds. Okay, what about disposing of accounts receivables? Okay, sometimes you will have a receivable and you want the cash right away. Well, there are different ways that you can dispose of your receivables or convert your receivables to get early payment. One thing that you can do is you can sell or factor the receivable. Okay, let's do an example. Kyle, let's say you owe my company $10,000, okay, but it's not due for 90 days. I need the money now. But you're $10,000, you don't have to pay me for 90 days. So what I do is, let's say you have a factoring company, Tony. What you might do is you might give me $9,800 today. I have my cash, albeit a slightly less amount, but I have my cash today. And then I go away. Then when you pay your $10,000 amount, Kyle, you pay Tony. You with me? You don't pay me. So I basically sold that $10,000 receivable for $9,800. You made $200 off that situation. I got my money early. Everybody's happy. That's called a factoring company will do this. Does that make sense? Okay. The other thing that you might be able to do is you might be able to just go get a loan and pledge that receivable as collateral. Receivables with creditworthy companies are usually strong collateral. Okay. One last thing, the ratio at the end of the chapter is the accounts receivable turnover ratio. Remember how we talked about inventory turnover? We want inventory to turn over. We want that cycle to occur efficiently so that cash is predictably and consistently coming in. Well, we want our receivables to turn over. Okay? We want them to turn over, all things being equal, quickly. So if our AR starts to turn over slower, maybe because our credit manager has been kind of lax, or maybe the economy's getting bad, that can result in future cash problems. So by keeping track of our AR turnover, we could maybe predict that a little bit. How do we compute AR turnover? We take net sales divided by average accounts receivable. Are you with me? All right, now we are done. We went through a lot today, okay? Do the homework on your homework sheet, guys. Make sure you're doing your homework. Folks at home, do your homework. You cannot learn accounting without doing your homework, okay? Always be checking the dates on the website calendar, folks, for due dates of tests and Connect assignments. We will see you guys later. Bye-bye.